Hey everyone, and welcome to this explainer. Today we're going to completely change the way you think about investing. A lot of people assume that succeeding in the financial markets is all about having a crystal ball, trying to guess which single stock is going to skyrocket next. But honestly, the world's most successful investors don't play guessing games. Instead, they rely on a proven mathematical strategy that prioritizes long-term financial survival over short-term luck. And today, we're going to unpack exactly how that works. Our roadmap for today's masterclass is broken down into 6 simple steps. First, we'll look at the single investment trap. Then, what is diversification? Next, the 4 levels of diversification, followed by misconceptions and hidden risks. Finally, we'll cover how to actually diversify, and we'll wrap up with the ultimate investing secret. All right, let's jump right into section 1, the single investment trap. To understand the solution, we first need to look at a high-stakes scenario that traps a lot of beginners. Picture this for a second. Imagine you've managed to save up 10 lakh rupees. It's your life savings, you've worked incredibly hard for it, and you're ready to invest. You do everything right? You spend weeks researching, you read all the financial articles, and finally, you find what looks like the absolutely perfect company. Strong growth, visionary leadership, a totally bright future. You feel so confident that you take that entire 10 lakh and put it into that one single company. But then, out of nowhere, the unexpected happens. And it could be anything. A fierce new competitor enters the market. Government regulations change overnight. Maybe consumer trends suddenly shift. Or the CEO just makes a terrible decision. Because absolutely all of your money is tied up in that one single place, your portfolio takes a catastrophic hit. Your entire financial foundation was built on just one pillar. And the moment it cracked, everything collapsed. Which brings us to section 2. What is diversification? This is the core principle of professional risk management. At its heart, diversification simply means spreading your investments out across multiple assets rather than dumping all your money into a single basket. The whole idea here is to avoid being overly dependent on any one outcome. Instead of betting your life savings on one company, you spread it across dozens or even hundreds of investments. Sure, some might disappoint you, but the crucial takeaway is that a single failure doesn't wipe you out. Your financial future isn't relying on a single coin toss anymore. Think of it like being a farmer. If you decide to plant only one specific type of crop and a disease hits that specific plant, well, you lose absolutely everything. It's completely devastating. But if you plant several different types of crops, the risk becomes entirely manageable. If one fails because of a weird weather pattern or bugs, the others might still thrive, keeping your overall harvest totally stable. This is exactly what happens with investing. Look at Investor A versus Investor B. Investor A is that farmer with one crop. If their golden company collapses, their wealth vanishes. It's game over. But Investor B, they own 100 stocks. If one of those companies goes totally bankrupt, the impact is a drop in the bucket. Their portfolio might dip by a tiny fraction of a percent, and the damage is strictly contained. By spreading your money around like Investor B, you're directly reducing what the pros call company-specific risk. This just means the unique problems that an individual business will inevitably face, things like a failed product launch, a messy lawsuit, or an accounting scandal. Diversification acts like a customized shield, protecting you from being dragged down by the daily bumps in the road that any single business is bound to hit. Let's move on to section 3, 4 levels of diversification. Because true diversification isn't just buying a bunch of random tech stocks. We actually need to peel back 4 distinct layers. Let's build this step by step. Step 1 is company diversification. Like we just talked about, owning many businesses instead of one. But wait, if you own 50 tech companies, a crash in the tech sector still ruins you, right? So step 2 is industry diversification, mixing tech with healthcare, banking, and maybe manufacturing. Then comes step 3, geographic. If you only invest in your home country, a local economic downturn is going to sting. Investing globally protects you from those single country recessions. And finally, step 4 is asset diversification. Stocks are just one type of asset. Mixing them up with bonds, real estate, and commodities creates a truly bulletproof financial foundation. Now, the secret sauce that makes all these layers work together is a concept called correlation. Correlation simply measures how investments move relative to each other. If you own a bunch of things that all rely on the exact same economic conditions, they're going to crash at the exact same time. We call that high correlation, and it's exactly what we don't want. We want low correlation. We want to own different things that behave completely differently under the exact same conditions. Just to put that into perspective, notice how different assets play totally different roles depending on the economic weather.
During boom times, technology stocks might absolutely soar, but when panic hits the market, they are highly volatile and they drop fast. Government bonds, though, they behave completely differently. During a panic, those boring, low-return bonds provide incredible stability right when your tech stocks are falling. By owning a mix of both, you smooth out the terrifying swings and make your overall ride so much easier to stomach.
All right, Section 4, Misconceptions and Hidden Risks. Now that we understand the mechanics, we really need to clear up some dangerous myths that confuse a lot of everyday investors. This is probably the #1 question I hear. People ask, okay, if I'm spreading my money out across all these different safe and risky assets, aren't I just guaranteeing mediocre returns? Won't I miss out on making a fortune? And the honest answer is yes, kinda. If you diversify, you're almost certainly going to miss out on the thrill of dumping all your money into one tiny startup right before it explodes into $1 billion company. But in exchange, it drastically lowers your risk of total financial disaster. And listen, in investing, survival is everything. A portfolio that simply survives for decades gives you the time you actually need to safely compound your wealth. We're not trying to gamble here. We're trying to guarantee your long-term success. But let's also be real about the limits of this strategy. Diversification is a fantastic shield, but it's not a magical force field. It cannot prevent all losses during a massive global financial crisis where literally everything drops at once. Also, more is not always better. Owning 500 companies gives you amazing protection, but going out of your way to own 510, that adds almost zero extra benefit. It's about intelligent balance, not just hoarding as many stocks as humanly possible. Which leads us perfectly into Section 5, how to actually diversify. Back in the day, building a perfectly balanced 500-stock global portfolio required massive amounts of money and endless, exhausting research. But today, we have a cheat code. Everyday investors can now use modern tools like mutual funds and ETFs, which stands for exchange-traded funds. Instead of trying to buy hundreds of companies one by one, these funds pool money from millions of investors to buy a massive ready-made basket of assets. With a single click, a single purchase of an ETF, you instantly spread your money across hundreds or even thousands of the world's best companies. It completely levels the playing field. And finally, Section 6, the ultimate investing secret. We've talked about the what, the why, and the how. Now let's talk about the single most important takeaway for your financial journey. Here's the brutal truth. Long-term wealth is not built by frantically jumping between hot trends or panic selling every time the news sounds scary. It's built by respecting the fact that nobody, literally nobody, can predict the future. Diversification frees you from the pressure of having to chase that next superstar stock. It lets you step back, embrace patience, and let the mathematical magic of compounding do the heavy lifting over time. And I think it really comes down to this brilliant idea. Success isn't always about being exactly right. Often, it's about making sure you're never catastrophically wrong. Let that sink in. Stop putting pressure on yourself to perfectly predict a single stock, and start focusing on building a resilient, globally diversified portfolio that ensures you stay in the game no matter what the market throws at you. So as we wrap up this explainer, I want to leave you with one big question. How resilient is your portfolio today?